of social science research and health services research is actually in healthcare, and Nick and I have crossed paths on some work related to the Affordable Care Act and the rollout of the illustrious healthcare.gov and other issues related to healthcare reform that's going on. But we're very pleased that he's here today to talk to us about managing risk and surplus, a perspective on the financial risk for insurers. And there's a lot of things that have come up this morning that obviously equate crop insurance and other kinds of insurance risk on the practices that we're talking about. So we're very pleased to have Commissioner Gerhart with us.
Well, it's great to be here. Thanks for the invite. When Senator Bolcom invited me, I saw I wasn't going to be speaking about healthcare, so I jumped at the opportunity. So thank you, Senator. When I was going through this presentation at home with my wife, just kind of covering the topic, I mentioned to her that it seems like every time I get asked to speak somewhere, it's always about some pretty serious topic, healthcare, primarily last year. This is a pretty serious topic, and I said, I don't feel like I can even ever tell a joke, and my wife said, well, that's good because you're not funny anyway. So I'll spare all of you from my lack of jokes as we proceed here today. So really what I'm going to talk about today is the impact on weather and insurance, primarily property casualty insurance, but arguably other lines are impacted as well, primarily from how they invest. So for instance, in the life and annuity business, their biggest risk, if you will, is they may be carrying mortgages or residential mortgage-backed securities of some type on real estate that's impacted. So they could have an impact, not a direct impact like the property casualty world, like crop insurance, homeowners, auto, and things of that nature, but they could have an impact as well. Recent headlines, I wanted to kind of just start, in the last few weeks, there were some recent headlines. Weather variations could cost the U.S. economy $534 billion a year. That's from Business Insurance, dated 11/26. Storm losses put pressure on German property rates. Business Insurance again, 11/18. And then from the Des Moines Register on November 23rd, November Midwest storms flood insurers with claims. These are just some headlines that had popped up in about a week and a half, 2 weeks before I turned into presentation. There's been more since this. What's interesting is here you have a headline from a German perspective here in Des Moines, and the weather variations is more of a U.S. So the reason I pulled these three is I think you can see that it's not just an Iowa issue, it's not a U.S. issue, if you will, it's a worldwide issue. And you might ask, well, why do we care in insurance? What should we care about? Well, I would say, the world is very complex. It's a very complex system that has to adapt a lot, where sudden and violent change is possible. Towers Watson, a very well-known actuarial firm, actually has done a research paper where they have walked through a number of risks that face the globe, not just insurance, but other risks, political risks, things of that nature. What's interesting, each of us live once, right? And we're all in a single universe. Problems we face are really in a series. They're not parallel. So what I mean by that is an extreme event could happen to any of us at any time. And that's kind of a humbling thing. So I always say, well, what does average mean? We often hear 1 in 1,000. This is a 1,000-year flood, a 500-year flood. The odds of this or that happening is 1 in 100, 1 in 1,000. So what does all of that really mean? Does that, what is average, and what does that all mean if you say things like that? Well, I would submit if I walked out of this building, and probably not today, but if a fall, rainy day, and if I got hit by lightning, that would be a very improbable event, but it'd be a pretty high loss event, right? So I may not have a lot of comfort thinking, well, the average, of me getting hit by lightning is 1 in 1,000 or 1 in 100,000 because it actually happened to me. So what's interesting from our perspective in the insurance business is that it's difficult for us to really project, price, look at those kinds of events, and really difficult to understand and assess these low probability events that correlate to a high loss. But the good news is I think our understanding is evolving, and it evolves every day. So with every day we're seeing new tools out there. Big data carriers are now pushing into the insurance world. I know we've got some carriers represented here. I think they tell you that really the carriers themselves are becoming big data companies, if you will. And they're working with other vendors that are big data companies. So I want to cover the financial impact. I was pretty amazed when I saw this first statistic. Through 2010 through 2013, insurers paid, on average, going back to average, $70 billion annually around the globe. It's a pretty big number. What I found also interesting, I went back in time, I wanted to say, well, what does that mean and how does that compare? And this is from Allianz, which is a worldwide carrier out of Germany. They've got a very large U.S. footprint as well. But what their statistics show is that between 1980 and 1989, the average was about 15 billion. From 2000 to 2009, it was about 40 billion. So the insured losses have gone up pretty dramatically. 2012 global economic losses around 150 billion. That's according to Munich Re. The United States in 2012 suffered 11 weather catastrophes over $1 billion in insured losses. So that's quite a few. And then the U.S. Department of Commerce estimates 70% of U.S. businesses could or would be affected by some sort of a disruptive event involving weather. And again, the economic impact, going back to that headline we started with, is about 534 billion impact. So you might say, well, why? Why is what's happening? I think there's a lot of reasons, but one reason that we believe and we've looked at is we've seen a lot of economic activity, a lot of development in some coastal areas. What I didn't say on the slide here is about 90% of these losses we talked about are in the United States and Europe. Well, they are the most sophisticated economies, I would say, for the most part, most developed economies. They have the most capacity on an insurance basis, the most, the biggest, largest structures, if you will. So when you think back to Sandy, we're going to talk a little bit about that, Superstorm Sandy, it hit a very densely populated area with a lot of expensive structures, costing roughly 60 billion in damages, 35 billion about insured losses. So, there's that component of it as well. So what is the U.S. impact? 9 of the 10 most insured loss events were in the United States in 2012. Sandy alone was $35 billion insured losses. Insured losses for the first half of this year are down from 2012 and 2011. But then you don't have to think too far back and think about Moore, Oklahoma, the tornado there. I don't think we have a final number, but it's between $2 and $3.5 billion in estimated damage in one relatively medium-sized or smaller town, arguably. What's the Iowa impact? I think we all remember the Cedar Rapids, Iowa City flood. We may not remember that it was $6 billion total damage. It's a lot of economic damage in the state of Iowa that year. But overall, I think Iowa's what I would call a good risk. What do I mean by that? I mean, other states probably arguably have more to lose. We talked a little bit about the coastal storm in Sandy. Our largest risks, if you will, are going to be around crop losses, flooding. Those are probably our largest risks. We have not seen, to our knowledge, a carrier that's left the state for climate reasons. We've seen it in other states where some companies have said we can't have the capacity to insure the losses in these states. So you've seen some carriers in other states just pick up and leave the state. They're not going to do business in those states. So from an Iowa perspective, we actually are a pretty good risk, relatively speaking. What we're starting to see, though, is some companies are getting very sophisticated on their modeling. What I mean by that is they're trying to more accurately attempt to project future losses rather than just rely on past historical data. So what does that mean to the average Iowan? Arguably, it means that when you get into this kind of modeling and tiering, that they may try to do what's called a multi-state rate, if you will, levelize the rate over a number of states. We haven't seen that yet, but that's something that we are aware of and would watch, because but I think the market would correct itself, to be honest. Carriers, there's a lot of carriers that are in the property casualty world, and when they see an opportunity, they're going to be striking for that opportunity, in my mind. But again, other states have a lot more to lose, just from the events that have happened in their states, the events that could happen going forward. And so I think Iowa, as an insurance risk, is a lot better off than many, many states. So how much did consumers pay carriers for premiums? Well, in 2012, and it cut off here, so forgive me, the total was $316.8 billion. It's a lot of money that circulated through insurance companies to cover these risks. And if you think about it, why do we buy insurance? Well, we buy it to cover us when we have a potential loss that we can't afford, or to self-insure. So not too many of us want to replace our home, right, if we have a fire or catastrophic weather event. When you're driving, you have to have auto insurance, but even if that mandate weren't there, again, you wouldn't want, most people losing a car would be a pretty catastrophic event to replace that. The liability, if you were to do something, hit somebody, again, you insure for the unknown. I was talking to somebody before I was up here. The interesting thing about insurance is that we buy insurance hoping we never use it. So it's one of these products and services that you have to have and just hope you never actually use it. Oh, there's the 316. So insurance issues, response, and strategy. So I'd like to say the insurance sector is really positioned uniquely between the causes and the impacts. What do I mean by that? I mean, insurance companies are insuring kind of the front line risks. Maybe, if you're talking about climate, they're insuring the homes, they're insuring cars, they're insuring the manufacturing facilities, they're insuring all of these entities at that front end. And on the impact side, if something happens, they're there to foot the bill and pay the bill. So the insurance sector has a strong interest in working with their clients to mitigate that risk. And what we're seeing, especially in the flood arena and some of the reinsurance world, if you will, some of the major losses, the people that are there to cover the catastrophic losses, they're starting to employ and work with engineers and things of that nature. So we're starting to see the insurance sector really step up to work with clients to mitigate some of these large risks. But at the end of the day, insurers look to avoid risk, spread risk, and if they can't, they'll mitigate it working with their customers and clients. So what are some of the mitigation tools that are out there today? We're going to cover these quickly. So pricing is the first one. What do I mean by that? A carrier will look at its book of business, look at the states they're doing business in, they'll project losses, they'll look at their models we talked about earlier, but they have the ability to change their pricing going forward. Diversification, I think this is key. I've talked to many carriers that will tell you, and we're going to talk about a little bit more of this later when I talk about underwriting, but diversification, not having everything concentrated in one area. Think about the Moore tornado. If you were one carrier that was your book of business, you're looking at some real catastrophic losses. Now, arguably, those carriers, even if they had that concentrated loss, would have reinsurance to cover some of the losses. But again, they look at diversification as a real important tool. Reinsurance. Reinsurance companies are the insurance companies. So there's a big market for these players to come in, and a carrier may have a stop loss or some aggregate loss limit of X, and then the reinsurance triggers, and then if it's above that, then it goes back to the carrier. There's all kinds of creative structures on reinsurance. Climate modeling, we talked about that. This is getting more and more sophisticated, and there are big data companies now who are starting to create a niche in offering services and products around climate modeling. Cat bonds or catastrophe bonds. How many people have heard of these? Nope, nobody? Okay, this is an interesting, okay, a couple people. Well, I'm going to kind of back up and because this is a market that's really starting to expand worldwide. I mean, AXA over in Europe 2 weeks ago did a $474 billion offering. So, I mean, these are huge offerings that are going out there on these. And what this is, it's just like another bond, but what the company does is they go through what's called a special purpose vehicle, so a captive company, another company. They would set up a trust there. Then that company is going to work with investors, so only institutional investors, so you and I would not be able to directly buy this. But then we put the institutional investors, so a pension fund, an insurance company, large pooled funds like mutual funds, could be buying these. They put in their money, and it's structured around a specific weather event happening or not happening over a number of years. So it could be over a 3-year or 5-year, the typical years. So for instance, I could, if I was carrying the liability on 801 grand here, I could, and I was worried about a catastrophic tornado, an F4 or 5 hitting the building, I could draft a very narrowly crafted bond for several $100 million. Investors, fully informed investors from the institutional side would look at that and say, okay, we'll take that bet, and they'll buy it. And then if the event happens, they forfeit all of the money they put into there. If the event doesn't happen, all the money I paid as the carrier in premiums gets paid to those investors in interest. The thing that I'm finding interesting about catastrophe bonds is they're starting to go more and more mainstream. This year, this sector of the investment world has returned on average about 9%. Investors like it because it's not correlated to the financial markets. So you may hear more and more about these catastrophe bonds. They may go more mainstream. FINRA, the self-regulatory organization that regulates securities, put out an investor alert on this not too long ago. So it's something to just keep your eye on. Other mitigation tools. There's some tools that have been developed really around, I guess they call it weather risk mitigation. So, but I would submit you really have to define a business risk first for that to happen. I want to talk briefly about what is weather risk management. And forgive me, because I'm going to read a quote here. And this is from Allianz. Again, they're that worldwide carrier I talked about earlier. Weather risk management is the management of financial risks that are directly or indirectly linked to the occurrence of an observable weather event or variability in a measurable weather index. Different industries may respond to similar weather events in different ways, and this is one of the many reasons for the unconventional nature of this business. If done well, it will allow companies that take more control of the financial impacts to compete better. An example they give was heavy snowfall obviously would hurt an airline, disruption of travel, things of that nature, but it would help the big company that's doing snow removal. So companies have different responses to the same event. So this is what I would say is a market that's developing. It's been around for a while, and it's an interesting tool that some companies are starting to look to. But again, you have to have an awareness of the market. So the folks that are in risk management at different companies are starting to become more and more aware of this. I would submit the key is the availability of accurate data. Again, how do you price something? How do you, if you think about it, really what some of these strategies are, they're nothing more than a futures contract. That's really what they are. But how would you price a futures contract without knowing what the risks are, what the data is behind that? Unlike traditional insurance products, physical damage is irrelevant. I think there are a lot of policy issues to consider with this burgeoning market. First off, I start when I talk to some of these companies, what is it you're selling? Is it weather insurance? Is it a swap? I think a lot of us have probably heard about collateralized debt obligations and things of that nature. This is arguably an insurance-linked or weather-linked security of some sort, is what I would liken it to. So, but I think we have to have fully informed people making this decision. I was talking to one company that's in this space. I said, the last thing I want is you going out to a bunch of Iowa farmers, telling them they don't need crop insurance, and they buy this and realize they don't have the coverage they thought they had. So there's a lot of policy decisions in my mind that we're having discussions, and I'm actually meeting with one of these big companies next week to go through what it is they're doing, just so we have a better understanding of it in the state of Iowa. Something that's kind of been under the radar, in my opinion. So how many people have heard of the NAIC? Probably, I'm not going to assume everybody, but the NAIC is the National Association of Insurance Commissioners. So the state of Iowa, we're a member of this group, and really what it is, it's a group of states and regulators to get together, collaborate, work on industry issues that are emerging across the country. 2008, they did a white paper on this. Arguably didn't get a lot of traction. They did a climate disclosure survey and findings. The largest state that has done this is California. They put out 400 surveys to companies doing business across the state of California that have over $300 million in premium. Out of the 400, I'm going to read through a few statistics that I found when I was covering this. 264 of those companies indicated climate change poses a risk. 174 indicated an increase in hurricanes frequency and severity. 87 identified regional risks on climate change. So that goes back to what we talked about earlier about Iowa may not have as much to lose. We might have a different risk profile, if you will. The risk stated, but there's no quantitative assessment of risks and financial impacts. Kind of what I started the presentation with. It's very hard to say what is the impact and how frequent are one of these low probability, high impact events going to happen. What's that going to, it's very hard to price that. No company altered its portfolios due to climate change. I don't know if that's because the risk's not big enough I don't know if that's because the risk is not identifiable enough or measurable, but that was one of the findings. No company indicated a change policy result as a result through these changes. So in other words, not a lot of rate changes, if you will. What was interesting is they did talk a lot about computer models being used more. Not a lot of details on addressing. I'm going to talk about, maybe in my opinion, why that is. ORSA, that's a new law that the state of Iowa adopted, thankfully. Senator Bolcom and anybody else who's in there, I'm forgetting. What this is the own risk solvency assessment law. I would argue that many of these issues I'm talking about today might fall into this. And the reason I say that goes back to, you might talk about the life insurance industry. They have huge portfolios. We have some of the largest life insurance companies in this state. And arguably, we want to look at their portfolio, look if they have concentrated risk in one part of the country, could they be subject to this? So we're going to look at this. But what this law does, it allows regulators to do a much deeper dive into the enterprise risk management of these larger carriers. State of Iowa, we're going to have 12 or 13 carriers that are going to file these. And so we are going to look at least having conversations around, well, how do you mitigate all of your risks? And I think arguably one of the risks is this. And there's a pilot program going on right now at the NAIC with ORSA. Several of the companies, especially in the property casualty world, have identified climate, weather patterns as an issue that they're looking at in part of their overall enterprise risk management. So where does all this leave us now? I would submit that insurance carriers manage weather risk every day. They do that through their surplus. You know, I've had several CEOs of large carriers say, yeah, I care about weather. If I don't have the surplus to pay for a catastrophic event, we're out of business. So yeah, we care, and we watch this every day. Underwriting. Again, this goes back to the diversification point I mentioned earlier. A good example of this, I was talking to a local company not too long ago. They said what they've done in their models is they looked at an event like the Joplin tornado from a few years ago. They laid that catastrophic event over their entire book of business to find the 2 or 3 most concentrated risks in their portfolio of business. Interesting concept, but they found that they have 2 areas that are very concentrated. That if an event like this happened, arguably their surplus would be hit pretty hard. So again, that's an interesting thing that carriers do. And then the risk hedging strategies, those futures contracts, reinsurance, things of that nature. Our biggest risks, I believe, are flood and crop. Those risks are primarily held at the federal level through the National Flood Insurance Program, through the crop program. But I want to spend a little bit of time on flood insurance. NFIP, the National Flood Insurance Program, is very underfunded. I don't know how many people have a policy, but if you do, your rates are going up quite a bit. And underfunded to the tune of about $25 billion. And the impact of that, the reason the rates are going up is under the Bigger Waters Act. That act is going to bring these rates up to what's called actuarially sound. So right now, too much money is being paid out. More money's got to come in to cover those losses that are being paid out. So what's the impact? If you're somebody that needs to buy it and didn't buy it in June of 2012, you have to go to a full actuarially justified rate today. And I've got a complaint in my office right now. This poor woman's going from $700 to $5,000 on a house worth $90,000. How does that work? I mean, so think about that. If you're this poor woman has said this is about probably equivalent for a mortgage payment. And so these are real issues facing real Iowans. And even if she had bought it before June of 2012, she would have been subject to a 25% annual increase till it gets up to that actuarial rate. So these risks are real, and it's impacting Iowans, and it's probably impacting people you know. Other big risks, hail. Wind and hailstorms can cause quite a bit of damage, and tornadoes. So continuing along, where do we go from here? Increasing use of third-party models are probably going to increase. As more and more data comes online, I think carriers are going to use these third-party models to justify rate changes. But they have to really reflect the risk, and they have to look at past results. I would submit that at some point you could see carriers using the models to maybe try to do some multi-state level pricing. We haven't seen that today, but that'll be something that could happen down the road. some carriers are stating unequivocally in their rate filings that climate change must be a factor in their rate process. So it's arguably being used to price that particular insurance product, that particular line potentially. It's being used in that equation, if you will. So I know I covered a lot of material. It's good to talk about something other than healthcare, so I appreciate that. I don't know if I have time for questions or not, but
Thank you. So we do have some time for some questions. I would like to start, though, and you didn't touch on crop insurance at all, and I know you weren't able to be here this morning, but there was a lot of discussion about that. I don't know if your office has a lot of connection to that, or if you could touch on what it is and your thoughts on how that might be affected by extreme weather issues.
yeah, we obviously would review the rates that come through. Arguably, it's tied to the federal government as well. So our role in this is we would look at the rates. They come in once a year. They're probably going to start coming in here in the next 30 or 40 days. And then that gets ready for this next year's rate filing cycle. And what we do is, we're in constant communication with those carriers. And it's an entry market. I think in Iowa, it's a pretty competitive market, arguably. There's plenty of capacity from what we can tell. There's interest in the market. The rates are pretty high. I mean, if you look at the average farmer, what they're paying, I think they're pretty high. That's why what we're starting to see more is some of those other tools that have developed, these weather risk management tools. For instance, you can go out and buy what's called a sunshine day policy. You could buy a rainy day policy. Depending on how many days it rains, you get paid or not. So I'm not sure how the Volcker rule plays in all of those futures contracts. I think you have to have a true justified risk to do that. But I think you're going to start seeing farmers using crop insurance and other tools to help lay off more of that risk. Because if you think about it, for a lot of, in the crop world, you have a catastrophic loss, you have your adjuster out there, you're going back and forth. Sometimes, arguably, my family's farmed for a long, long time. If you get to that catastrophic loss, there's not a lot of reason for the farmer to do any mitigation. But if some of these other tools are in place, there's reasons to do mitigation. So I think you're going to see other tools develop, and I think it'll only serve the farming community better. I just want to know what those tools are and how we regulate them.
So we're not there yet?
No.
Okay. We have time for some questions, sir.
I have a question about the insurance companies seem to be way out front on climate change, and particularly the reinsurance companies. You mentioned the reinsurance companies. Munich, you mentioned, Munich and Swiss, the two biggest reinsurance companies, are saying that because premiums are simply unsustainable based on the house example you gave, for a woman's in a floodplain, can't afford the premium. Particularly looking at coastline flood, they're saying that there's another mitigation that they are calling for, and that's a carbon tax. So the only way we're going to fix this problem is go to the cause and put a tax on carbon and begin to slow global warming. Can you comment on that?
Well, I think it goes back to my comment that
Do you mind just repeating the
Oh,
question?
I'm sorry. The question was, some of the large reinsurers, that kind of like I talked about, they have, in their filings and in their transactions with, the reinsurers are more on a transactional basis with the carriers, but they have stated that climate change, global warming are real things. I think really the question was, some of the carriers, Munich Re, Swiss Re, have even said, really, looking at that root cause, is a carbon tax should be used or implemented. Is that fair enough? Okay. So I think it goes back to my comment earlier. Insurers are uniquely positioned at the outset, and they're liable for the impact. And I've had conversations with a number of large carriers. I'm not going to say their names because I don't have the permission to say that, but they would agree with that. And so it'll be interesting to see, if you think about building codes, insurance industry is really some of the primary drivers of updating a lot of those building codes. Because again, they were liable for the impact. So I think it'll be interesting to see how many of these large carriers get in, but $70 billion has been the average insured loss for the last 3 years. And arguably, the other issue I didn't talk about is the problem we're seeing in some of the developing economies around the world. Look at the typhoon from not too long ago. Not a lot of insured loss there because there wasn't any insurance. So, I mean, that's the other issue, that carriers are starting to think about, how do we get into some of these other markets, and is there a business opportunity there? So that's something to watch, I think, in the next 10, 20 years, too.
We have a question about, a couple of people about, this is crop insurance, and there have been a couple of suggestions to tie crop insurance rates to conservation practices. And my question is, what sort of data would you need to be able to generate appropriate rates that are specific to conservation practices?
That's a great question. So the question is, what kind of data would we need to look at conservation practices to then price the corresponding risk on the rate?
Yeah.
Fair enough. Well, I haven't seen the issue in terms of a carrier actually bringing it to us, but I'd have to think through, for us to say that it's actuarially justified. That's a really good question. I have to get back to you. I haven't seen it yet, but it's something that carriers probably are thinking about when they look at their overall insured risk they're carrying for that particular farm, and they can go back now in time. They have much more real-time data that's available that comes out every day now through technology, so it's probably coming. And I do have a question about, I talked about the NFIP program and the rates going up, and then somebody asked, well, hey, there are bills in Congress to repeal that, and what's going to happen there? I have no idea. I kind of live in what I kind of know, and when I delve into what I have no idea about, I usually get in trouble. But again, it may happen. I mean, they may go look at these rates. The fascinating part about this Bigger Waters Act is the authors of it, they'll tell you they had no idea it was going to result in this. They didn't know it was going to go from $700 for this Iowan to $5,000. Well, if you looked at the numbers, you could have figured that out. So, we'll see what happens. I really don't know.
I just have more of an anecdote to relate to that question. In 2005, I believe it was the insurance commissioners were meeting in New Orleans when Hurricane Katrina hit and canceled their convention. And Al Gore was scheduled to speak to them about the effects of climate change on the insurance industry. And so I was just kind of surprised to see that more action what did come out of that event.
Well, we had our '08 meeting in Philadelphia was canceled for another large storm too. So I think, and as someone who has to spend my weekends there, like I have to this weekend, I wouldn't be that upset. But again, I get another weekend because you go to these meetings and they're very grueling. But it is interesting. I mean, the NAIC white paper, I'm not even sure if it fully got published. I mean, I had to go dig for it and find it. It talks about not authorized for reprint on it. So, yeah. So I don't even know what that means. So maybe I had special access. I don't know. Probably shouldn't have said that. But
So with respect to flood insurance, we define things as the 100-year or 500-year. With risk map and other programs and statewide floodplain tracking plan with Iowa that will define 6 levels of risk. Is there any interest either statewide or not taking this? Because it's certainly a pilot project coordination to look at more actuarial risk assessment across the floodplain for premiums.
So-
Someone that's just inside the 100 years certainly different than someone that's right.
Well, absolutely. So the question is, we talk about the 100 or 500, we have new maps. And I think that's a great point. I mean, again, this person I talked about earlier, if you look at it, and I didn't draw the map obviously, but she is at a different spot in my mind than what the true high risk should be. And yet, because of the way the map was drawn, she's in this higher risk A zone. And what I didn't tell you about that story is she refinanced her mortgage in 2004. The bank didn't tell her about this. So she gets a notice, goes out, has it redrawn as a C level, so it was a lower risk. But now, apparently, the old map is the one we have to rely on. And so it's very confusing. And for the consumer, she did nothing wrong. She followed the rules, and now she may be displaced from her home. I mean, if she can't afford this increased premium. And we're trying to appeal it to FEMA and do all that. But, it's I think it's an idea we're talking about is looking at that map so you can more accurately price and give the carriers the ability to more accurately price that.
I have a sense that internationally, some of the largest urban areas, and insurers and reinsurers are looking very carefully at whether it's a 10-year, 25-year,
Absolutely. And with big data, I mean, with the data that's available now, I think every 2 years we learn more and more than we knew, you know, it took us 10 years to get what we know every 2 years now. So, again, there are carriers out there that are using some of these very sophisticated big data companies. Some former executives at Google founded a company called Climate Corp, sold it for $900 and some million to Monsanto. I mean, these are the kind of businesses that have been developed, and it's worth a $1 billion company. All it does is really data for carriers, for farmers, to help price that risk.
I'd like to follow up to that last question. In the case of this flood modeling data that's very precise and really could allow a actually sound rate for this woman and for all the other people who need flood insurance in the state. For $1 million, we could publish several more layers of data and allow people to make an accurate defense. If the agencies that normally ask for that budget are not allowed by the government to request the money, as insurance commissioner, can you step up to that political challenge of getting enough money to give these flood premiums at a better rate?
Well, you know, I think we're starting now to see some of the impacts of it. Oh, sorry.
I'm sorry, could you just
Yeah,
repeat?
so the question was, some of the agencies that need to be engaged on this are constrained by the budget, and what can we do? What we're starting to see on the flood issue is it's just now really impacting what I would say everyday Iowans. And so there are some states that are filing lawsuits and getting engaged on that. I'm not sure if that's the right answer. I think the better answer might be, coming up with a plan, working with probably people in this room to say, well, what is the plan? And if we can look at the cost and the benefit, I'd absolutely have no issue trying to bring that forward, and if it made sense. I mean, but again, this is an area that I look at my staff, and people think we're the experts on everything, and I mean, I've got some people that are pretty engaged on issues, but I don't have anybody who's focused on this particular niche of the property casualty. You know what I mean? I don't have that person on my staff, so we'd have to rely on outside resources, to be honest.
Would it help our risk management efforts if we were to adopt something essentially modeled on Obamacare so that insurance companies were part of the exchange and that we all could participate in managing the risk?
So the question is, should we take the Affordable Care Act model and use that as a delivery system for insurance? And I'm not sure that would really do much to change the risk profiles. I would argue that in this world, there are a lot. The agents are out there; they're pretty engaged on all these issues. They can shop rate pretty quickly. We're fortunate in Iowa where we have some of the lowest auto and home rates. Arguably, I think we're the third lowest in the country. So I think that from a risk perspective, but again, I think you'd have to look at some states. There's been at least one commissioner that has said that's a good idea, and that we need to do it in his state, but he has a completely different risk profile than Iowa.
We have time for one more question, if we have one.
All right, well, thank you.
Thank you, Commissioner. Okay, we're going to just take 1 minute. Ready to go? Yep. Okay. And we'll be transitioning to our next speaker.